everyone, and thank you for being at the CRG Lunch and Learn today. Today we'll be discussing buying and selling real estate in the age of COVID-19. We're really excited that you're here today, but honestly, we wouldn't be able to do any of these things without our sponsors. So Michael, can you please tell us who our sponsors are and give them a thank you?
Yeah, absolutely. And Barb, thanks again for leading this. And we're going to go really fast today, everyone. So we have Builders, Colorado Cleanup Services, Ferguson BAC, Harrison Home Systems, Phoenix Framing, Burnco Materials Marketing. We've got Rio Grande, Milgard, First Integrity Title, Anchor Engineering, Genesis Roofing, Venture Painting, Owens Corning, Maxway Services, Westera Credit Union, Lifescape, Colorado, McClure, ABC Reprographics, Blind Corners and Curves, Colorado Builder, New American Funding, Windermere Real Estate, Strategic Insurance Services, Pro Home, Colorado, Wyoming, and Closet Factory. Thank you.
So now I would like to announce our MC for today's program, Miss Sherry Cannon of First Integrity Title Company. Take it away, Sherry.
Thank you, Barb, and good afternoon to everybody, and I appreciate, we all appreciate you joining us today. We've got a great panel lined up for you. We've got some wonderful questions that we thought would be impactful for you to know and to understand what's happening in our current world today. And as you saw on your screen, if you do have any questions during this program, please let us know because we want to touch on everything that's a concern to you. But at this time, I'd like to introduce everyone. First, I'm going to start off with David Neff. David graduated University of Colorado in 1985, Business Administration, 30 years of experience in the commercial banking industry and commercial lending. Vice President of Westera Credit Union in Cherry Creek, which this company does $1.5 billion in business, has decades of experience in all facets of our industry, commercial, construction lending, including term and construction loans for multifamily, retail, office, industrial, special purpose loans, including car wash, self-storage, airplane hangars for all of you that need an airplane hangar, hospitality, hotels, flex office, warehouse space, mixed use, the list goes on. Also has specialized expertise in residential construction loans, both speculative and custom. So definitely a gentleman to know. Our second panelist is Michael Beninati. We all know Michael Beninati as one of our founding fathers, if you will, of CRG. But Michael is the owner of Windermere Real Estate, for those of you that live under a rock. Michael is in his 14th year in Colorado real estate. His firm focuses on residential new construction, corporate relocation, and investment properties. Michael and his team are strategically located in Colorado Springs to Evergreen. Michael is also a graduate of the Armbrust Real Estate Institute and has held an appraiser's license and is a short sale foreclosure certified. Michael has built his team on long-term relationship as trusted advisors. And then this brings us to Renee Boulay. We all know that the real estate market is very volatile, and we have Renee as a loan officer with New American Funding to share what's happening in the mortgage industry. Renee has been a part of the Construction Resource Group for over 8 years and has served on the board for Professional Women in Building. She is extremely knowledgeable. I can attest to this personally as we do business together as well. And she is a valuable resource in all real estate financing. So I want to welcome our team. Thank you for joining us. And I'd like to start off with a couple of questions. First, general questions. Are we seeing any general trends in the construction projects that you're working on? You know, social distancing for an example, you know, how many people can come in a home? What are, you know, the repercussions of what you're seeing out there in this world that we're in currently? Michael? Yeah, it probably relates more to you since you're the realtor up front.
Absolutely. Thank you so much, Sherry. Great interest for everybody. We are seeing some changes in how we show property. For a couple things, we'll start with resale, and then I'll go to new construction. So in resale, it's a one-to-one relationship with the showing service. So only those that are on the contract are allowed. Also, no overlapping showings. That's a huge win for us. A lot of you on this call, a lot of you in part of the CRG group know that we were locked down early on in early March, which was a challenge for us. But we've been showing for about 3 weeks, and I think things are so far going really well. Sherry, as you asked, yes, we have to wear gloves and a mask when we show property, which we do. On new construction, it's actually flowed pretty well. So some of the production builders, we've been able to contact or reach out online to the either on-site sales rep or the builder directly and make an actual appointment, which is nice. The nice thing about that is it does give the buyer a little more time with the on-site sales rep than normally they would have instead of just walking the property. And then with some of our custom builders, if a house is already in process, we'll call them and schedule them. Otherwise, it'll be a Zoom call just like this of what maybe plans would look like, what maybe a time frame would look like from architectural all the way through.
So once you get your client under contract, are you noticing any increase in cancellations or demand or increase in sales activity as a result?
Both. So when we were locked down and we had the state said that we had to be under contract first to be considered a real estate transaction, it was almost every time one went under contract, it came right back on, right? But right now, we just ran a report. We provide a report called The Scoop every week, and we just did this for the 7-county Denver area, and right now we're 10%. So 10% of anything under contract is not closing with the first buyer for one reason or another. That's the first issue. But we are seeing increased sales activity and increased interest with buyers that we've been trying to work with for a number of years. Number one, with the interest rates being where they are, but number two, people being stuck in their house for the last 10 weeks. Sometimes that house is no longer going to work for them.
Right. Well, and you touched on interest rates, and this is, for David and Renee. Interest rates right now are an all-time low. How are you seeing this impacted, in our COVID experience? Renee, I know there's a lot of programs out there. We've talked about forbearance. Can you touch on that a little bit and explain that to us?
Well, to first speak about the interest rates, as we all see on TV, it seems like it's a topic on the news constantly, but the feds keep pumping more and more money into mortgage-backed securities, which is helping to stabilize and helping to manage the liquidity of the interest rates. Is keeping them low, and they want to continue to keep those rates low as we come out of this COVID experience and businesses slowly recover. So we do foresee and expect, and all the economists are basically saying the same thing, that they expect rates to be low for the next couple of years, actually, which is really a good thing. I'll touch on forbearance. You mentioned it. It's a hot topic right now. A lot of people were, whether they needed it or not, I know that there was a need out there for a lot of circumstances, but some people were, yeah, the forbearance isn't as wonderful necessarily as one may think, because there are consequences if you do enter into forbearance. As much as that, whoever's holding that note, they might tell you it's not going to affect your credit, and it may not affect your score, but it does show on your credit report whether or not you're in forbearance. So you could own 10 different properties, and if you're in forbearance on one property, it could affect whether or not you're able to refinance or purchase. And there's different options that you have if you are in forbearance, but based on your circumstances, but there are consequences to it. So you can either bring your payment up to date, make your mortgage current. That's one option. If you don't do that, let's say you went through the 3-month forbearance period and you want to purchase a home or you want to refinance, currently, the current guidelines require that you make at least 3 months in a row of payments on time, and you have to be able to show that. And you have to rerun the credit report to make sure that the forbearance part on the credit report has been removed as well. So that has to be reported by that lender that the forbearance has been closed and removed. So that's a couple of the circumstances that buyers are in right now.
So what, I'm sorry, so what happens, when someone has a low credit score now? I mean, the different, government loans that, are available. I understand that there's some pullback on.
Yeah, there is. So right now, because there's been such the market's been so volatile, a lot of people, God bless them, they've lost their employment. A lot of homeowners have entered into forbearance, for example, and for those folks who have lower credit scores, you know, the secondary market, the industry sees them as a higher risk, obviously. There's a reason they may have a lower credit score. And so they've pretty much artificially raised the rates in some circumstances, or they've created different credit requirements. So they currently, if somebody has a real low credit score with most lenders, not all, but most lenders, they're going to have a very difficult time refinancing right now. And the feds in the industry are trying to, I mean, they're very concerned about this, because if people were credit approved before, you know, we're trying to put them in the same situation so they can take advantage of maybe refinancing or purchasing now, right? So at our company, we actually go to a 580 credit score, for example, on an FHA loan. I can't tell you how many loans we're getting from other lenders because they've raised their credit score minimum to 580 or 700. Wow. So they're trying to rectify that situation to help people out, but a lot of the lenders don't want the risk of a low credit score person.
Sure. David, explain to us self-employed borrowers and how they're affected by the guidelines of COVID.
Well, for self-employed borrowers, I mean, on the commercial side, self-employed, a lot of times people are self-employed, and depending on what they're, you know, what they're trying to borrow on, it can impact, you know, usually we're looking at their income history over the last couple of years. Commercial loans aren't driven as much by credit scores as Renee talked about. They're more driven by, you know, the experience of the borrower, how much equity they have in their project, what they're trying to do. So on the commercial side, I think you're still, you know, talking about interest rates, you are seeing low rates. So you have a lot of people that are refinancing their commercial deals, you know, of all kinds, office, retail, industrial, special purpose. So, you know, I guess I can't really speak to specifically self-employed individuals. On the commercial side, every deal is just kind of looked at, you know, individually based on what they're trying to put together.
I wouldn't mind touching on this, if you don't mind, for our builders that are on this call. One of my concerns from a residential lending point of view, and when you have a self-employed, because I work with a lot of builders that do luxury homes or jumbo loans, anything over $575,000. My concern, and Michael, you can probably speak to this a little bit too, is that so for these people who have been self-employed for 2 years, that's typically you have to be self-employed for 2 years and 2 years tax returns. So let's say 2019, they had a real strong tax return because everything was normal. Here it is 2020, and their first, second, possibly third quarter, their income could significantly decline due to COVID. Not everyone's, but you know, some will. So if you're a builder and you have borrowers and you're not closing until, let's say, 2021, it's really, really important that you are partnered with a lender that's going to be on top of that, because if they file their taxes for 2020 and if their income declined more than 25% from 2019 to 2020, which is going to be a reality based on COVID's experience, right? That could make them to where they're not approvable, or they have to go with a manual portfolio route. So that's my concern with the self-employed due to the 2020 first 2 and 3 quarters.
Is there any new funding available to developers and builders?
That'd be David.
Yeah.
Yeah, there is. I mean, I would say most of the banks and credit unions are still out there, you know, lending money. I think a lot of them are really looking hard at any of their current members or borrowers and trying to really take care of the people that they've already got relationships with. But even in new projects, we're still seeing a fairly steady stream of new builder projects, construction projects, and then just a lot of refinances of existing projects that are, you know, leased up and doing well. So there's definitely still money out there, new money out there in the market for all kinds of commercial and construction projects.
Well, that's
good news.
Yeah. Are there any financial concerns or opportunities for investors? I mean, we've got a wide spectrum of you know, folks in our organization, and they kind of dabble in a lot of different things. How does this come into play for them?
Well, I'll take a piece of it. I think there is. I think there's a bull market in a lot of areas. I think there's been investor buyers who sold property off 24 months ago, 36 months ago, have been waiting. And I think now is the time. Right now would be the exact time to identify properties, for example, in the Denver core, where they could maybe purchase now, potentially put a tenant in there while they go through the process of approvals for zoning, potentially, and then have available land to sell to home buyers, right? I think that's one huge opportunity. I think the other side is you've got people that want to sell and potentially do a 1031 exchange, potentially. I think that's a huge opportunity for people that, especially those that bought short-term properties to use as short-term rentals and what's happening in that space today. I think you're going to see a large amount of those properties hit the market sooner rather than later.
I've still seen also on the commercial side, and it's commercial being a commercial loan, but there's still more residential projects. But I have seen a ton of projects where people have bought an old house or found a lot in an urban area where they want to do a construction loan on. So, and a lot of times you're seeing an older home that can be scraped off, say in Rhino or in the Sloan's Lake area, where basically the way the zoning is, you can have a house that's scraped off and they'll build a duplex on it, or sometimes they can even build a 4 or 5 unit multi-tenant, either apartment or for sale units. So because the market's so strong, especially still in Denver, you're still seeing a lot of new projects where investors are going in, buying a home, scraping it, putting a duplex or a triplex, or even sometimes 4 or 5 unit apartment if the zoning's right. So we're seeing a lot of projects like that. And I think many banks are still willing to make those deals, and even if they're speculative, where at the end of the day, you know, they're going to sell those units. Also, the bank tends to look at them where if the market really turned down and you couldn't sell the units, what could you rent them for? So if they're in a good central area, and you know, if the market turns, but you can still rent the units up and make the loan payment. So there's kind of two ways banks are looking at that, but that's a huge opportunity that a lot of people, you see a lot of those going on still today.
Good, good. How do you see builders and realtors working together during this COVID age?
Well, a couple things. One is you touched on it earlier about the relationships, and I think builders, developers, you know, it's critical to partner with full service, full-time firms, right? That have great title representation and great lending representation, and that can get transactions completed. That's the big deal, right? I think the other side of it is to have the tools to market those properties. It's no longer okay just to throw it in the MLS. It won't work, right? You've got to have the digital technology of Matterport and floor plan, drone work, and those are very expensive. I mean, our costs double or tripled in less than a month to market a property, but we're getting transactions completed and we're getting them done quicker and faster. That's important. It's also important that when someone's looking to purchase some dirt, so Dave, I'll stay with what you're saying. We talked a little bit about the inner Denver, which is true, but what the calls we're getting now, or agents are getting now, is they're looking in Elizabeth and Franktown, maybe Colorado Springs, Sedalia, right? So it's about saying, hey, if something goes south with this project, can we resell it? Because you might not rent it, right? And number three in that conversation is the big thing that's rearing its head right now, Sherry, is voice, video, and data. So it's the facilities in the ground as people are working from home. So we're having to learn a lot about that too. So working with builders and developers on that's been it's been helpful.
Well, and Michael, you touched on something about, you know, how we live currently. I mean, we're all officing from home. And when you've got two individuals needing office space where normally it's never happened, you know, the dining room is now an office in my house. So, you know, on the builder spectrum, you know, are they rethinking floor plans now? Because I think this is going to, you know, change the way we live, because we've proven to ourselves that we can work from home. So are you hearing feedback from clients that you're showing properties to with regards to a blueprint of a home now?
Yeah,
and how that's really going to function?
Yeah, absolutely. And you've got a couple of spectrums, right? You've got homes that are already in process, homes that have already been in play, especially with our production builders, and those we're gonna have to sell through those, right? But we are seeing that. You've got 2 people at home. They're going to need separate offices. Plus, the other thing we need to talk about too is all the homeschooling, right? Distance learning. And then, right. And the other side, you've got college kids. I know you've got one, right? And what is that going to look like moving forward? And so the house has got to be able to function differently. So yeah, that's definitely a question. And the other thing too, I think that now that people will have the ability to be a remote worker, to virtually work, well, they can live anywhere. They don't have to be in DTC or Denver or Boulder. They can live in Elizabeth or Colorado Springs or Vail, right? So they can live in a lot of places, but the home has to be functionally, work for them. Not only price, right, Dave and Renee, and be able to afford it, but functionally be able to leverage. So those are questions that we're starting to get now. And so I think the future with architects and developers and home building is probably going to look a little bit different. Yes.
Good. What are you seeing the timelines of getting a, transaction to the finish line? Is it?
So we have our scoop. You just talked about our scoop. So right now we're 20 days on market. So which is down 47%, which is huge for us. 20 days on market. If somebody is fully pre-approved, and Renee can help talk through this, fully pre-approved, we're seeing closings happen 21 days, right?
We're still able to close them as rushes too. We're still closing rushes.
We have not seen major delays on that. So that's been pretty smooth.
Wow. And Renee, so you're seeing, this pretty much flowing well.
It is. With our company, we're seeing it flow very well, actually. And it does go back to, the team that we have in place and our processes. We do try to pre-qualify people and have everything taken care of as much as we can up front. But back to what you talked about, jumbo loans, with a lot of lenders that have discontinued their jumbo loan program, we've had to take several of those scenarios on trying to rescue different loans, different FHA and jumbo loans, and we've been able to do that in a very short period of time. But then again, that goes back to the relationships that you have and why it's important to be with the right realtor, the right commercial lender, the right people to make sure that they've got your back and leverage those relationships for sure.
David, how does this affect the commercial world?
I would say on the commercial side, similar, that we're still seeing a lot of deal flow. We're looking at a lot of deals. There's a lot of, we've got plenty of things to work on and look at. However, on the commercial side, I think the process is slowed just a little bit. It seems like it's taking us a little bit longer to get a commercial appraisal done and reviewed. Sometimes if you have to have a phase 1 environmental report on a commercial property, that can take a little bit longer. So some of the ancillary reports you need to get a commercial deal closed can take a little bit longer. That said, we're still getting things to the closing table. Maybe it's taking a week or 2 longer than it normally would. So while the process is slowed, it's still moving along and we're still getting a lot of things done and closed.
Okay. Can you guys touch on jumbo loans for us?
That's the hot topic.
Is that a dirty word? It sounds like.
Well, so I don't want to get too technical here. So basically the jumbo loans, so the feds are pumping in money into the mortgage-backed securities. That's for like Fannie, Freddie, FHA government loans, right? The jumbo loan market is a private market, and they're considered a lot high risk. And no one's buying those securities, the jumbo securities. So what we've seen in the last month, it's much better than it was in March. March flowing into April was really difficult. And that's pretty much when a lot of the jumbo lenders started to bail. However, we're starting to see the market stabilize. We're still doing what we have seen, that they're making the guidelines a little bit more strict. They've increased credit scores. You have to higher credit score like 700, where before we could go all the way down to 600. So the credit requirements are more strict. Down payments have gone from, instead of 10% as 20%, for the down payment minimum.
Big jump.
But pardon?
That's a big jump.
Yeah, it is. And a lot of the secondary lenders, like the credit unions, that would offer like an 80-10-10. So if someone put down 10%, you could have a second lien on a second mortgage on that property, but a lot of the, most of them, I would say, probably 95% of them are no longer offering those loan products on the jumbo loans. So the jumbo loan market, I don't know what else to say. Our rates are still low, so we're still in the threes, so that's good. And we're getting them done in a very timely manner. We're doing them 30-day closings, so that's good. But they are more challenging, and the guidelines are a little bit more strict. They're certainly harder on the borrower for what they're requiring now. Yeah.
Okay. We do have a question that came in. How has COVID impacted the spec home market? Anybody want to take that one on?
I'll jump in there.
People couldn't get in to see it, right? Until recently, until a few weeks ago, if you had a spec home sitting there, you know, they'd have to, now at least they can make an appointment with the builder or the sales representative or a realtor to go see it. But if you had a spec sitting before, you were kind of in a bad situation.
Well, it would have started, right? So there's kind of a couple ways to answer this. I'll answer it from the end user side, and then I think Dave's got a perspective on it moving forward. So if there's a spec home sitting out there today or in process, that was been in process for a while, maybe 18 months ago, right? When that dirt was purchased potentially and then going through the city. That's number one. And you would have had blueprint appraisal or blueprint drawings on it to show. However, if you're going to get into one of those that's out there, you still have to schedule it. You still have some distancing. You still got PPE, those type of things as well. But I will say that on a couple that we've worked on recently, we've just spoken with the builder on a call just like this. And they pulled up what it's supposed to look like, you know. So those type that are already in process, I've not seen anything major other than the jumbo financing piece that Renee just spoke to. But I don't know anything about anything moving forward. We haven't been involved in anything moving forward since March 16th. David, have you?
Yeah, I mean, on the front end, I would say it is a little bit harder to get speculative projects approved. I think several of the banks have kind of pulled their horns in, and they're not doing, especially bigger multifamily projects that are speculative. You know, historically, people have liked to see pre-sales in those. Well, it's really hard to get pre-sales in a project that hasn't even started, especially in this environment. So I think on the front end, it is a little bit harder to get speculative deals approved because there's less lenders out there doing it. That being said, I think, you know, you still can find lenders, including Westera, that are doing speculative deals, but we're looking harder at the project. We like to see a little bit more equity going into the project up front. We like the sponsors of the deal to have more liquidity in case things don't go as well, more backstop. So, you know, on the front end, speculative projects are still getting done, but I'd say it is tougher and there's less lenders out there doing it right now.
Okay. Well, next we're going to go through some silver linings. Are there some unexpected outcomes that you're experiencing that are having a positive impact on your business or profitability?
Well, for us, what I can tell you is that in the last 6 to 8 weeks, we've seen a consistent increase in pre-qualifications and applications. So that's a really, really good sign. As far as the silver lining, I spoke to this a little bit earlier. Because of the feds pumping so much money into the economy, I think that's going to help us keep interest rates low for the next couple of years, which is a good thing. I also believe that, well, you talked a little bit about remote closings. I think some of the new processes that have been developed throughout COVID, right? Whether it's a drive-by appraisal or curbside closing, I think that there's going to be some processes that hopefully will not be eliminated after COVID and after we get back to normal. So I think there's some positives in those areas.
Yeah, we're seeing that on our side too. You know, we're improving. You know, we had to get on the bandwagon quickly with that remote title services, and we just want to perfect that and make that a secure opportunity for everybody. Yeah. How about developing, you know, forging new or strengthening old relationships? Are you seeing that?
I take that one. Yeah, I would say that it's probably our relationships with our clients, our top 50 each client, our top 100 sphere, is for our realtors has been stronger than it's ever been. I think getting on the phones, getting off of text, and you're off of social media and you're off of email. People are at home; they've got the time, right? And I think that really doing those health checks are huge. I also think from a relationship perspective in our industry that we've been able to really separate those who are really in it, they're full time, they're all in, they're all engaged, and how are we going to help each other with our businesses, right? Versus those that, you know how it happens, those of us have been around long enough now, it says, you know, you don't hear from people, then all of a sudden the market turns and they won't stop calling you, you know? So I think those who are really solid and those that are in are those relationships are getting stronger and stronger than they probably even were a year ago or 2 years ago.
Well, I think the value of having a preferred relationship, whether it's with Michael or David, or just having that preferred relationship, I believe that those people are more committed to keeping the builder, their referral clients, everybody informed of what the changes are and how it's going to affect them. You know, I talked a little bit about self-employed earlier. You know, a lot of the builders, they're not thinking about their buyers' tax returns in 2021, right? So that's an example of if you have a relationship with someone, I think this has been a more important than ever. It's important to have that relationship because those people have your back. They're going to keep you informed of what's happening, what's changed with the existing clients, what they need to look out for in the future too, and how it could affect them. So I think more than ever it's important.
I would agree. I also think, you know, kind of going back to your last question too, silver linings on the commercial side, because rates are still low and some of the lenders have pulled in their horns a little bit on, you know, doing new projects and speculative projects, but we see a ton of refinancing going on and lenders have more time. And I think they're really wanting to keep their good borrowers in-house. And if they've had a good loan that's on the books, you know, and they can lower the rate and keep the deal, they want to work with their client. They really want to try to help out their existing customer base and try to, you know, give them a better rate, give them a better deal, do their new project, whatever. So yeah, working with the relationships with people that you've been doing business with for a long time, it's super important. And I think banks and credit unions are kind of bending over backward to help those people out as much as they can.
That's a good point, David. So with our company, one of the things we did to help our borrowers, because we service a lot of our loans, but we had a special program with the FHA, with our FHA borrowers that were already existing, to where they could refinance all the way to, regardless of where their interest rate was. If it was, you know, like above 3.75, for example, they could refinance into 3.25 rate, fixed rate. And so that was, and we did this with no closing costs at all. We didn't charge any closing costs. They didn't need an appraisal. There weren't any fees involved, and we didn't even need their credit score or anything. So that way, if they were not in a good, so it was this kind of a streamline, but that way, for those people, it was our way of helping our current clients to lower their monthly payments and take advantage of the lower rates. But a lot of them, if you do a normal streamline, sometimes there can be some out-of-pocket costs on a normal streamline, where our company really contributed a lot to try to avoid that and help people get into a lower rate, lower their payments during this COVID experience.
David, have you heard if there's going to be a third PPP coming? And can someone apply again?
You know, I have not heard that. I know, you know, a lot of people were frustrated with the first round of PPP because, you know, that tranche of money got used up quickly. But I've heard, you know, through the second round, I know a lot more borrowers and our members were able to go ahead and get those PPP loans. And I think a lot of people wanted to look into it with their CPA, make sure it made sense for them, make sure they understood the guidelines of what it was like, you know, to pay it back. So I have not heard if there's going to be a third round of those. I know a lot of people took advantage of those, which I think is great. You know, that's what it's out there for, to help those businesses, to help people, you know, stem the tide until things get back to a more normal situation. But as far as a third round, no, I have not heard one way or the other about that.
Okay.
For those borrowers that have, for those self-employed borrowers that have applied for the PPP loan, that's something the Jimbo investors are really looking I mean, they're like with a microscope looking deeply, and it's like, why did you need that? And how, you know, and if you had to provide, let's say a P&L, a year-to-date P&L, in the past, it would be year-to-date. Well, now they're asking for P&Ls by the month because they want to see the trend of exactly how COVID has affected their profits, their income overall. So if someone was in a PPP program, then as a self-employed borrower, they're going to have to explain to that jumbo investor, well, why did you need that? How was your business affected? So you can't really say, well, we weren't really affected. We still have, you know, our income's on track for as 2019, but then you apply for something like that, you're going to have to explain that. So there can be some issues there.
Okay.
I would say, yeah, on the underwriting side, you've seen a lot. I mean, even on commercial deals, for example, I've been working on a refinance of a multi-tenanted office building. And I think, you know, lenders have to look much deeper into what is the tenant base, what industry are they in, you know, how many of those tenants asked for rent deferrals, how many of them got PPP loans. So that's one thing that's slowed down the underwriting a little bit on the commercial side is I think people are really looking harder at all of those aspects of their business to see how is it going to impact them and how is it going to impact their ability to pay the loan back.
Okay, good to know. All right, here's a big one. Are there any lessons you've learned from 2008, because we've all been in the industry this long, to 2010 that would apply to what you might be experiencing today?
There's a lot of them.
And it'll take us to the end.
Yeah, there's a lot of them. I would definitely say, you know, keep your emotions in check, right? I mean, you know, on a Tuesday, the world looks one way, and by Friday, it looks totally different, right? And make decisions based on, you know, some facts of long term, obviously. I'd also say that another piece of it is a good principle is not getting overextended, right? And not choking down the largest possible home you can buy, right? You know, really living within your means and really understanding what your life's going to look like and what does life potentially look like, not only today, but a year from now, 3 years from now, 5 years from now, you know, as well. So those are some different conversations we're having with buyers and sellers for whatever move he or she may want to make.
Okay. Renee?
We're definitely seeing, I'm in agreement with Michael. You know, I'm in agreement with Michael on that. I'll just go with that.
Yeah. I would say the same.
Lending is hard. You know, the lending's just really, really hard. But I think this is really temporary. I really do. Our rates are going to stay low. Although 2008 was different than what we just went through. And I think even with the forbearance issues, you know, those are going to be gone probably, in my opinion. Those will not be an issue in 6 to 8 months, right? I think, you know, 2008, that went a lot longer. I believe what they went through. I think we're going to come out of this in a much better way than 2008. And I think with the lending and what the feds are doing is really going to be beneficial too. But I think everything's going to change and start to stabilize. We're already seeing it in lending. We're starting to see things stabilize, and I think we're going to be. I'm very hopeful and optimistic that we'll be back to normal within the next probably 3 to 4 months. I recognize there's businesses that are still going out of business, and employment will still be an issue. But I believe in our circle that we're talking about right here, I think it's going to continue to improve.
A couple questions have come in. Overall, do you think the slowdown COVID has produced is healthy for the real estate and building industry as a whole?
I do. Yeah, I do. I think we were top of the band. Yeah, we were top of the band, no doubt about it. And I think that a lot of people, especially that first-time buyer, was just priced out of the market. So I think that's really helped them out. I also think that it's also, we've right-sized a little bit from our processes, right? So you're buying the right house and the right price points, but also people that are stepping up and stepping down now have a different opportunity than they did even a year ago. So I do think on that side of it, this has been somewhat good. And I think on a process perspective, specifically on the real estate transaction side, Renee mentioned title. You know, Sherry, you and I have had conversations about how title went a 10-year leap in 10 days. I mean, really, it's been amazing, actually.
Right.
Yeah.
So I think that that's been a big win, and I think that we'll see that continue. I also think on the showing side of it, the technology side of it, realtors have drugged their feet. They've drugged their feet on this technology, and I think they've been forced to do things like Zoom and things like Matterport and drone and whatnot. And it's made us a little sharper and a little quicker in the market. So I think from that perspective, I think it's been good.
In lending, we've been flooded with refinances because of rates, as everybody knows. So for us, it's been good as far as business wise. But Sherry, you asked, like, has it been good for the builders? And I'm not sure in what way the builders may have benefited from anything in the COVID. I agree the technology, and going forward, there's going to be some positives, you know, as we've had to adapt. I think going forward, it's going to be positive, but during it, I don't have a good answer for that, but I don't see it really.
David?
Yeah, I think on the commercial side, you know, certain industries have been, or certain segments of the market have been hurt, where certainly retail right now is tougher. Those businesses are struggling more. Hospitality is another one that we were doing a lot of lending. That's really been slowed down and curved back because a lot of hotels and things have very low occupancies. And so I think a couple of segments of the industry on the commercial side are going to be impacted a lot more. I think also, as Michael talked about, you know, now for investor builders, you know, looking at speculative projects, whether they're residential, multifamily, whatever, it's not a good time to really go out and you know, over leverage yourself or do a huge project. Maybe be a little bit more conservative. And I think it is a little bit tougher to get loans approved for those kind of deals on the commercial side. So, and maybe that's a good thing. Sometimes it's okay for the market to pause and take a breath and slow down a little bit. And maybe in a few months, things will have picked right back up and we'll be fine. But I think now is not the time to really leverage yourself too much and to really go for it on these bigger projects.
I'm seeing that with my client base. My bigger projects, they're not off the table. They're just on hold. And then they're going to come back. They're just, you know, want to see what's going on in the stock market and the, you know, all kinds of different things. But it's still encouraging. That's the good news. I think that's a large difference from that era, which, you know, of mac and cheese and top ramen. You know, things aren't as bad as it was then. We do have one other question, though, that has come in. And Michael, and I know, Renee, you've got a strong builder portfolio. Are builders ramping back up? And are they offering any kind of incentives to realtors, lenders, and or the buyers? Are you seeing any of that?
A little. I don't know that there's this big ramp up, but there are some incentives. We're seeing incentives to at least get under contract for some of these homes. I think what happened in the last 10 to 12 weeks is some of these builders have been able to get caught up. They've been able to work ahead a little bit. And so now they're at a place where they may have lost their buyer that was going to buy that house, as Renee alluded to earlier. So now they want to get it closed and get it sold. So we're seeing a little bit of that. I'm not seeing massive lending incentives. I don't know, Renee, maybe you can speak to that.
Yeah, I think we're certainly offering some incentives to assist our preferred builder partners. But I will say this, I'm seeing the builders that I've been blessed to work with, I've seen them bring a much larger seller incentive as well to the buyers to help them maybe buy down the interest rate or to pay 100% of all the closing costs. So I have seen, especially if it's a spec home, if they have some product that they want to move in the next 3 months, I've definitely seen builders increase their seller incentives.
I think we're going to see that in the fourth quarter. I said normally you get into that post-Thanksgiving to the end of the year, and you usually see that a lot with production, the discounts and they go crazy. I think October 1, you'll see it earlier this year to try to get them closed by the end of the year. I do. And I will tell you this, we have had a couple examples of where a client had a home under contract for new build, and through COVID, a home became available, a resale home that they really wanted, and they walked away from the new build, and they the discount on the resale was great enough to lose their earnest money on the new build. We have had a couple of those, but not a lot.
Wow, that must have been a spectacular home.
Yeah, there's a few of them out there.
Yeah. Well,
Yeah.
and that just, lends to another question on the impacts, and you touched on it, Michael, for, how it's going to affect our industry from, third quarter to first quarter of 2021,
Mhm.
what we're
Yeah,
going to see.
normally, our market in the front range is about February 15th to the end of June. We are on fire year over year. We kind of die out July and August, and we ramp back up September, October, a little bit of November. I think this year, it's gonna pop later. I think we'll pop in August, September this year as we start to heal and get people back to work and figure this out, right? Figure out what life looks like for all of us. And I think the fourth quarter might be pretty strong. Where normally it's strong from a closing perspective, usually with new build for us, because we put them under contract in March, April, May, so we close at the end of the year. But I think we'll get a lot under contract in the fourth quarter that will close in the first quarter of next year. So I think it'll just shift a little bit. The demand is still there, and we need the new construction. We need the homes built.
Yeah, there definitely is a shift. I mean, obviously, I feel it as well. Being tied to the title industry. Where you're normally, at the end of summer, you're getting kids back to school. Kids are going, to colleges. It's completely changed now, and now we're all cagey. I mean, today we get to go to a restaurant. I don't know what that looks like yet. Maybe after this meeting, I'll figure that one out. But the normal cycles that we typically have in a normal real estate environment are definitely changing. Have definitely changed.
Yeah.
Hopefully that's going to be the good news.
And while we're on this question, there's another question with regard to inventory. So right now we're sitting at properties for sale as of Friday. Last Friday this is going to be resale is about 6,200 total, which is down 17%. Now with that, I added another, I'm going to call it 400 probably for new construction sitting out there, probably plus or minus a few. So inventory is definitely still down, but what the other side of that is, even though you're hearing a lot in the media, the sold properties through last Friday, year over year, we're at 1987 we sold so far in May, which is, the business is off 50%. That's on the resale side. Now that does not include the new build. So again, if you use the math, it's probably these new builds are closing for sure, especially the ones that were under contract. So that inventory will start to come back up. People will start to figure out where they're going to go, where they're going to live, what their job situation looks like. And I think it'll just time it just right here going into the probably third and fourth quarter.
Do you see interest rates dropping even more?
I don't know, Renee, what do you think?
It is very possible. I mean, it is possible. The Feds definitely are doing everything to keep the rates down. And if they're worried about going into another recession or re-entering another recession as we come out of this one, they would lower rates in order to avoid that, I believe. That's what
I read an article recently that there's a minimum number. Doesn't matter what's happening. There's a minimum number the banks just aren't going to go below, right? Because you have a business, right? You got to pay somebody, you got to run the business, right? So I don't know what that number is, but I don't know. I think it's just gonna be up and down.
I think buyers, Michael, you can tell me if this is from your point of view, if this is accurate, but I think buyers were thinking after COVID that the values of homes were going to drop.
Oh.
I've heard that from a lot of people, that they were thinking that because of COVID or people falling out of contract or different things, that the actual appraised value of these homes, the market value is going to decrease. And we have not seen that at all.
No.
I don't see that happening in the Denver market. Now, that doesn't mean in, Des Moines, Iowa or somewhere that might be the case, but here in Denver, we haven't seen that at all.
Yeah, our May report, year over year, the average price in Denver, 487, which is off 2% year over year. So even in the recession of 2008, 9, and 10, I believe we were 2.8%. We were under 3 at the worst in Denver. So, I mean, we're sitting at 2 right now. We've held steady for a while. And it'll be interesting when the May report comes out, or it's going to be the June report, what that looks like. But no, it's off by 2%.
Well, we have one last question that's come in, and this is for Michael. There's some curiosity out there if you were at a party at the Ozarks this weekend.
I was not. I'm in Denver. I was not there, but
No, okay. Well, someone thought they
Osage
spotted you.
I tell you, it broke my heart to see that on national television. My happy place. But no, we're in Denver.
Okay.
I remember that place, Michael.
To the panel, is there anything else that you would like to impart with us that maybe we haven't covered, that I haven't asked, that is valuable for us to know? I think we kind of wrapped it up and covered and touched on everything that's
I'm personally feeling very optimistic. I mentioned it before, but I'll say it again. Our applications, pre-qualifications, and refinance, everything has steadily increased significantly, and it's been consistently increasing. And I'm optimistic with what I'm seeing in the traffic with the builders that I'm talking to. And they were appointment only. Now people can come and see their place. I just am very optimistic about our recovery, actually. Totally all around. There's going to be some changes, but I think it's going to be good.
I would say that I would agree with Renee. I would also say that our Construction Resource Group members and our Construction Resource Group sponsors have been a huge resource to me as a business owner. Nothing to do with sales, just as an owner of a company. Just all of you have been there in the last 10, 12 weeks just for questions or thoughts or support, which has been great. So I think that's a huge kudos to our resource group and our sponsors.
Thank you. Very informative, very enlightening. Thank you to our panel, to David, Renee, Michael, appreciate it. And as you mentioned, all of our sponsors that make all of this happen in light of a COVID environment, appreciate you all very much.
Thank you.
So, Barb,
Thanks for having us.
Absolutely, absolutely.
Okay, in closing, I would just like to say thank you very much. Thank you for being part of our panel today, and thank you all for being part of our CRG Lunch Club. So we look forward to seeing you at our next one, which will probably be in the next month or so. So look for information, and if you want to review this particular video, we will be recording it, obviously. We have done that. Please check out our YouTube channel, okay? And we will see you next time. Thanks so much.
Thank you.
Okay, thank you.